The velocity of money is a measurement of the rate at which money is exchanged in an economy. Simply put, it reflects how quickly consumers and businesses collectively spend money. It is usually measured as a ratio of gross domestic product to a country's money supply, with the formula showing the rate at which one unit of currency is used to purchase goods and services. The word velocity emphasizes the speed at which money changes hands, which tends to be higher in expanding economies and lower in contracting ones. The speed at which money moves through an economy is influenced by several factors. One is the money supply itself. When central banks increase the supply of money, people and businesses usually spend more, which can raise prices and contribute to inflation. Consumer habits also play a big role. If people decide to save instead of spend, money moves more slowly and velocity drops. But when people spend more freely, money changes hands faster and velocity rises. Finally, the way payment systems are set up affects how easily money circulates. Tools like credit cards, electronic banking, and mobile payments make it easier to spend, which speeds up the flow of money. If payment systems are limited or harder to use, the movement of money slows down. The velocity of money measures how quickly money in circulation is used to purchase goods and services, offering insight into the health and vitality of an economy. A high velocity is generally associated with expansion and growth, while a low velocity is linked to recessions and contractions. Although not a primary economic indicator, it is often considered alongside GDP, unemployment, and inflation. Velocity also tends to be higher in more developed economies and moves with the business cycle. During expansions, consumers and businesses spend more freely, causing velocity to rise. In downturns, spending slows, and velocity falls. Because of this close connection to economic conditions, money velocity usually increases when GDP and inflation are rising and declines when these indicators weaken during contractions. As an example of how velocity of money works, imagine an economy with two people, A and B, each holding $100. A buys a car from B for $100, then B buys a house from A for $100, and later pays A another $100 for construction work. Finally, A buys another car from B for $100. By the end, both still have $100, but they've carried out $400 worth of transactions. With $200 total in money supply, the velocity of money is 2, showing how the same cash can generate multiple exchanges of goods and services. The velocity of money, while often explained with simple examples, is applied on a much larger scale to measure how quickly money circulates through an entire economy. In this context, it reflects the turnover of a nation's money supply. Economists calculate it by dividing GDP by the money supply. GDP is typically used in the numerator, though gross national product may also be substituted. For the denominator, velocity is most often measured against either M1 or M2. M1 includes currency held by the public and transaction deposits at banks, while M2 adds savings deposits, time deposits, and retail money market funds. The Federal Reserve tracks the quarterly velocity of money using both measures. Economists disagree on whether the velocity of money is a reliable indicator of economic health or inflationary pressure. Monetarists, who follow the quantity theory of money, argue that velocity should remain stable unless expectations change. However, shifts in the money supply can alter expectations, influencing both velocity and inflation. In theory, increasing the money supply leads to higher prices as more money chases the same goods and services, while a decrease should have the opposite effect. Thank you for tuning in. I hope you found this video interesting. If you have any questions or comments, feel free to leave them below. And don't forget to like and subscribe for more informative videos. See you next time!